About 18 years as a graduate of the University of Florida, and he got an MBA somewhere else.
Miami.
Oh. And then, and he appears regularly on Bloomberg and CNBC, and his articles and quotes are, you can see them pretty often in Barron's, New York Times, and Wall Street Journal. Thanks for coming, Dan.
Okay, all right, thanks, David. I think what I'm going to do is I'm just going to start off kind of talking about Synovus. Synovus is not a household word in terms of a company you may be familiar with. Basically what they do, before I get into like an overview, is they buy banks, and they buy banks throughout the Southeast, and then they will buy 3 or 4 banks in Tampa, and they'll all put them together, and that's where I work. And I basically manage the money for the banks. And so this is kind of an organizational overview of my group. We have about $5.5 billion under management. We have 14 portfolio managers all through the Southeast. You know, Birmingham, up in South Carolina, Atlanta, Columbus, Georgia. That's where they're headquartered out of. And so I'll take you through that, and then I'll talk about the equity side, and then we'll do fixed income. We'll talk about our process that we go through and so forth. Maybe just real quick, is everybody in here pretty savvy in fixed income and equities in terms of understanding? If I start talking about duration or stuff like that, is that like a foreign term? Or if I start talking about top-down versus bottom-up, or growth versus value and that kind of stuff, so everybody's pretty on board with that. Okay. All right, we'll go ahead and I'll take you through this real quick. Basically, we trade on the New York Stock Exchange. SNV is a symbol. You can see $26 billion financial company. They also have a sister company called TSYS, which trades on New York Stock Exchange under symbol TSX. Anybody heard of First Data Corp, FDC? They do processing for credit cards. That's what TSYS does. They're the number 2 behind First Data Corp. This talks about, where the different focuses are: Alabama, Georgia, Florida, South Carolina, Tennessee. That's kind of where the different offices are and so forth. Basically, investment management, to kind of summarize what we are large cap blend, which means we do both value and growth, and fixed income. One of our areas that we feel we have an expertise is fixed income. On the institutional side, everybody wants to pick stocks off the internet and be a hot stock picker, but the reality situation is most institutions buy bonds. Insurance companies buy bonds. 85% of their portfolios have to be in bonds. Large institution pension funds, it's mostly bonds. So if you want to get involved on the institution side, opposed to what a stockbroker does, invest 100-share lots for individual investors and buy mutual funds, a lot of that is in fixed income, and that's a lot of what we do. In my office, I work with people who have $1 million or more. I will not work with you unless you have at least $1 million. And I work with large institutions. My largest account's about $60 million, which is an insurance company. We have insurance companies, foundations, pension plans. We have the state of Georgia is one of our clients. So this is kind of what we do. We're intermediate taxable muni bonds and corporates and so forth, treasuries and agencies. Large cap blend, that's our focus. We are balanced, account management, equity income. These are type of services. This is something that we would give to prospective clients just to get an idea of what we do. This talks about our approach, which is kind of just a grand scale of kind of what we do in terms of investing the portfolios individually. Let me talk a little about that in a minute. If you might have had other people come in here and talk about how they manage portfolios and so forth. A lot of the large banks right now, for example, Northern Trust, SunTrust, all the big trust organizations, what they do is they have 5 different portfolios, and they're all managed in a central location, and the portfolio manager simply just sits there and presses a button and puts a guy in a portfolio, and it runs automatically. And the portfolio manager absolutely does nothing except for take the guy out to lunch and make sure he doesn't leave. That's what they become to do. But in our organization, we actually are the old-fashioned stock-picking portfolio managers. We actually do our own research, and we actually customize each portfolio for the client. We don't just, put everybody in the same type of portfolio, the same allocation, and put it on a computer and go to sleep. And that's what a lot of the guys do now. And the reason why they do that with the big organizations is because from a compliance perspective, everybody has the same portfolio. You don't have a different portfolio as a client than this person over here because the portfolio manager decided to go a different direction with your portfolio, and that's why they do it. From a portfolio manager's perspective, I think it's really boring to just have a job where you just come in and you take people out to lunch all day and you look at 5 different portfolios that are run up in, New York, and they buy and sell stocks in there, and you have no say what stock goes in or what stock goes out. So I'm just trying to tell you the difference. If you start interviewing for like a junior portfolio manager job at a company, ask them, how are you going to be involved in picking stocks and picking bonds, or are you just a guy who's just kind of sitting there, looking at these portfolios? Because that's what a lot of them do right now. So that's kind of a difference between us and a lot of the, let's say, so-called bigger firms in terms of portfolio management. Excuse me?
Partly because I'm interested. And also, I think it's important for people to recognize this. A little bit about the process you go through with individuals with regard to asset allocation, mix of stock and bonds. Well, because you are, and I've been doing this I've had people here for 4 or 5 years. You are the first person that does not represent that's not people picking stock for a single managed portfolio, that does money for pension funds, and every pension fund client has the same exact stock portfolio, just different proportions. So this is new.
Yeah. Well, basically what we do is we find out what their objectives are in terms. We have a questionnaire. We actually grade them out, and what the grade comes down to is how much risk can you take. It's like if you grade really high, you can take a lot of risk, which means you're going to get a lot of stock. If you grade really low, you're going to go on bonds. That's what it really comes down to. We have a grade that comes down. They get assigned a score. And then from that, we have 9 portfolios that are target portfolios, and we have ranges on 55% equity, 45% bonds, and we can play with those ranges, but we have to stay within those ranges. So that's how we do the asset allocation. The allocation would be equities, large cap, which is our core, international, small cap, which we actually buy funds because we don't have a competency in small cap equity management. So we buy funds in that. It's usually like 5 to 10% of the account. And then on the fixed income side, it's usually agencies, corporates, and govies, cash, international, and then munis. So you'd allocate between those 5 or 6 different asset classes. So that's how we would do it. These are all these are just the resumes of the people in my organization. Pretty much everybody's MBA, CFA, or one or the other. So if you get an MBA, I have an MBA, I haven't got the CFA. If you don't have an MBA, you better get the CFA. Otherwise, it's going to be really hard to get into being an analyst or a portfolio manager. You can be a broker, but brokers are salesmen, and they work on commission, and they make a percentage of the revenue they generate in commission dollars. If you want to be an analyst or a portfolio manager, you get paid a salary and a bonus, and it's a whole different game. And you're working with people that are going to be more like the people like yourselves. They're more academic-oriented. They're more intellectual. Whereas the brokers are salesmen. I mean, they were selling cars, they were selling stuff in the mall, and now they're selling stocks. And portfolio managers, you either have an MBA or a CFA. And just about everybody in our group has either one of those. All right, let me jump to, let's do fixed income first, just because I'm assuming that's the less exciting of the group for you guys. Everybody wants to talk about stocks, what are the top stock picks and everything. But like I said before, fixed income is huge in institutional side. So if you've taken courses in fixed income and you have a good understanding of all these things, you will definitely do it. I mean, just in a nutshell, I'm going to go through this process, but I'll tell you in a nutshell really what fixed income management is. It's very simplistic. All you're doing is you look at the Shearson-Lehman Bond Index. Does everybody know what the Lehman Bond Index is? And the Lehman Bond Index has allocation between treasuries, governments, corporates, internationals. That's the allocation. And it also has maturities, 0 to 3 years, 3 to 5, and 5 to 10. And it has a duration. The duration of the Lehman is about 3.6. You're either going to be above the Lehman on your duration or below it, depending on what you think interest rates are going to do. And you're either going to be overweighted in treasuries, overweighted in corporates, or overweighted in agencies, depending on where the credit spreads are. And you're either going to be overweighted in your maturity from 0 to 3 to 3 to 5 to 5 to 10, or underweighted, meaning you'll have more in 5 to 10 year, less in 3 to 5, and less than 1 to 3. And the dispersion between that breakup of those weights is basically how you manage fixed income portfolios. It's really not that hard. I'll take you through this process, which, it's kind of the bells and whistles, but that's how you manage it. For example, if you think interest rates are going to go up, what's going to happen Tuesday? Is everybody following the Federal Reserve? Supposed to meet on Tuesday. They're supposed to raise the Fed funds 3 3/4 from 3.5% on short term. And we'll talk about the disconnect between the short end and the long end of the bond market. But if you think interest rates are going to go up, what happens to bond prices when interest rates go up? Hope we got that part. Okay. If not, we better slow down. Okay, so if you think bond price is going to go down, would you want your duration to be above the Lehman index or below the Lehman index? The lower the duration, the less volatile sensitivity to change in interest rates. So if we think interest rates are going to go up, which means bond prices are go down, we want to be less sensitive to that change. So our duration match will be below the Lehman. Right now, we're below the Lehman. Does everybody follow that? That's kind of complex, but if you guys can follow that, that's good. All right, so here's kind of the minutia of it all. That's really basically what we do. But anyway, in terms of fixed income process, we look at the fundamentals in terms of the markets, strategic guidelines, cyclical patterns in terms of, for example, if you look at historical spreads between inflation and between where the Treasury should be. Everybody pegs off the 5 or the 10-year Treasury. For example, if you think that there's going to be inflation, as Alan Greenspan does, you would have thought that interest rates would be a lot higher on the long end than they are right now, right? Because the long end is actually, the rates are coming down, and the short end they're coming up, which is making the curve actually more flatter instead of more steeper. But we'll talk about that in a minute, but I'll shoot through these slides real quick. Basically, in terms of things that we look at, and I'm kind of touching on those, long-term forces, inflation, what we think interest rates are going to do, what we think the Treasury market's going to do. Everything trades off Treasuries, right? Munis trades off Treasuries, corporates trades off Treasuries. What the inflation expectations are. Obviously, Alan Greenspan thinks there's inflation, and the bond market doesn't. And that's why you have this big dispersion. What the premiums are between corporates, Treasuries, munis, and Treasuries in terms of what the historical spreads are, what the relative levels are. For example, sometimes corporates look cheaper to Treasuries or less expensive or more expensive. So we look at those different things in terms of deciding what our allocations are. This just talks about in terms of, looking at cyclical patterns, what's the view out there on the long end and the short end, momentum, different trends and so forth. What sectors, like is everybody pulling out of corporate bonds and selling corporates and going into treasuries? For example, after 9/11 occurred, we had a tremendous amount of foreign money that came into the United States and went into treasury bonds because people construed the U.S. market as the strongest market in the world. And what that did is it forced prices up in treasuries and pulled prices down that shouldn't have happened based on what was going on in the market. So that's like kind of a sector rotation, or it was kind of like the safety principle. Everybody's rotating into treasuries and maybe pulling out of other areas. If corporate earnings growth, which dictates corporate bonds, is starting to slow down, what would happen to the spread between treasuries and corporates? It would widen, right? Because people are selling corporates because they're afraid that the earnings power of the corporation to pay their interest isn't as good. So they would then rotate and go to a flight to quality, called a flight to quality, into treasuries, and they would sell their corporates. Vice versa, when the economy is doing good, people buy corporate bonds because they feel more confident, and the spreads tighten between treasuries and corporates. So these are all the, I'm kind of throwing examples out, but those are the kind of things that we look at in terms of, determining our strategy in the fixed income market. So here's what I just talked about, duration versus the benchmark. That's huge. I mean, that is really, quite honestly, if you manage fixed income portfolios, that's where you start. It's like, what's the duration of the Lehman? Am I above or below? I'm going to go below because I think interest rates are going to go up. I don't want my bonds to come down as much, so I go below and I put my duration below. Vice versa, if interest rates are going to go down, you would have your duration higher than the Lehman because it makes it more sensitive. So when the interest rates come down, your bond prices go up more than the index. So you outperform the index. Because when you get in front of a client, that's all they want to know. Did you outperform or underperform the index? It's not whether you were up 2% or down 2%. If you're up 5% and the index is up 3%, you're a winner. But if it's vice versa, then you're not a winner, even though you're up. So that's a huge part, is the duration part. Yield curve position, and I'll talk more about this in terms of, I talked earlier about the disconnect between the short-term and the long-term end, meaning that short-term rates are coming up and long-term rates are coming down, which is creating a more flatter curve. So we look at that. Sector allocation, different sectors in terms of between treasuries, agencies, and so forth. And I just talked about the different credit spreads between corporates and treasuries and so forth in terms of whether the economy is doing good or bad. So this is constructing the portfolios, position the portfolio optimum point yield curve based on the shape of the curve, the slope of the curve, overall volatility, properly diversify market sectors and securities in terms of security structure, credit quality, supply. I already kind of talked all about that in some of my examples that I gave in terms of what's going on right now in the markets and so forth. Does anybody have any questions? So far I'm moving kind of quick, but if you guys got anything, just stop, or if I'm totally blowing you guys away with all this information, slow me down and say, hey, I got a question. Go ahead.
You have 9 products?
We have 9 portfolios. One is like 100% stock, and one is 100% fixed income, and then in between that would be a ratio like 80-20, 70-30, 60-40, yeah.
And you have 14 portfolio managers. Right. What's like the dynamics of deciding we're going to go over in corporate bonds or under,
Well, we have the firm puts out where their policy, and then it's up to you whether you want to follow within a range of that policy. For example, they'll say, okay, we're under duration on the Lehman, so the Lehman's 3.5, we're at 3.4. They'll say that we're 50% in 3 to 5 year bonds, and the Lehman is 25%. They'll give you what their breakout is, and then it's kind of up to you whether you believe in that or not. If you think something different, you don't want to be. The problem with being a rebel is if you're wrong and you lose the client, they'll kill you. But if you're right in there with them and you lose the client, then well, I did what you guys I was within your ranges, and so you got to think for your own survivability. Do I want to be this rebel and be right? What if you're not right? What if you think something's going to happen? So you got to stay within ranges on the fixed income side. They'll come out and say, well, this is where we are, and whether you want to be, you can tweak it a little bit different, but the more you tweak it and the more you're out of those ranges, the more risk you have to yourself that if you lose the client, they're really going to say, well, you weren't even following our policy properly and you lost the client, you were wrong. So you're almost better to stay within it than be right, even if you're out of the policy, because no one's going to recognize you then. They'll say, well, you kept the client, that was good. Because the whole thing is keep the client because they pay the fees. So, yeah.
When you're trying to keep the client, are you working on the client, or do you increasingly have to deal with the client's consultant as well?
I don't have a lot of consultants, but I have clients that have board of directors that I have to deal with. Insurance companies and so forth. I have a lot of insurance companies, and they have board of directors, and they set up investment policy statements about what they can invest in and what they can't invest in. And I have to go in front of them, and I have to, tell them how we're doing, and they'll say, well, why did you do this, or why are you behind, or what happened? So it can become pretty tough. It's not just one little guy sitting there. But I know what you mean with the consultant, especially on the equity side. They'll just get rid of you and get another money manager and let him run the large cap blend part if you're not doing as well as you should in terms of the indexes. But I don't do as much with consultants, mostly with board of directors. Do you have a question in the back?
Why is it so difficult to find data? I mean, I could look up the value of 10,000 stocks right now, and I could probably get daily data on each of them back to 1970.
Right.
But if I want to get daily data on the Lehman aggregate,
right,
I might be able to get it for 1 or 2 years. That's it.
Yeah.
And maybe I can't even get a quote right now. I mean, why is there such a disconnect? And is it getting better, or is this just going to...
Where are you getting your data?
Well,
Bloomberg, you should be able to get the Lehman off the Bloomberg.
Right, but Bloomberg, Yahoo Finance, free stock.
Right.
And you get free bond.
Well, bonds trade inter-dealer. So you have a bond, you have a bond, you have a bond. I buy his bond, I sell it to you. Whereas stocks trade on exchange, so it's centralized, so all the information can be held much better, and it's easier to get and go on Yahoo on the internet. Bloomberg's pretty good, though, on the fixed income side. Not 70 years worth of the Lehman, but you could get pretty good data on the Lehman on Bloom. I mean, that's why Bloomberg exists, is because there wasn't enough data on fixed income. These guys trading bonds, and they know what's going on, and it's all dealer to dealer, so they created. That's why the guys, the mayor of New York City, I mean, he came up with that idea to say, let's make a centralized thing for bonds. So that's why we're...
Start off by saying that the institutional side is really focused on fixed income.
Right.
But the retail side is...
It's all equity.
It's all equity.
Yeah.
Why is there such a disconnect?
Because people are they're greedy. I mean, they want to buy a hot stock and buy a new house or something. Where the fixed income side, it's all targeted towards some sort of liability, meaning we've got an insurance company, and if we're a property casualty and we got hurricanes brewing, let's liquidate some cash, be prepared, we got to have reserves. Or if we're a life insurance company or workman's comp, and we know we've got a certain amount of liability associated with different claims, then let's target some sort of fixed income return, lock in some return to meet that liability. Where individuals are more like, well, I just want to grow my portfolio, or I want to pick a hot stock or something like that. So it's more targeted liability on the institutional side, where individuals, it's more greed. And it's more the bells and whistles of watching CNBC and Bloomberg and seeing guys like me picking stocks on TV and saying, hey, I'm going to go buy that stock at Charles Schwab, and hopefully it goes up.
Any corporate liquidation post-Katrina? Or is it too early?
I haven't seen any yet. No. Not yet. Does anybody have more questions on fixed income? Because I'm going to jump to equity. So I figured you guys would stay around for equity.
I have a question as far as... you could outperform or underperform the rate of price depending on the duration that you set.
Right, because of the sensitivity that of your portfolio has versus changes in interest rates. The higher the duration, the more sensitive. The lower duration, less sensitive.
More extreme positions than you would imagine if you have to forecast the future duration of the index? I mean, because...
No, you wouldn't be projecting the duration of the index. All you would be doing is making guesses about whether interest rates are going to go up or go down.
The index changes
every day.
Changes perceptions. Okay.
Yeah, it would change every day because theoretically the index is made up of a group of fixed bonds, and they're moving through time, and as they're moving through time, theoretically, their maturity is changing. And as you know, if you took fixed income courses, the longer your maturity, the higher duration. The shorter the maturity, the lower the duration. So theoretically, as you're moving through time, your duration is coming more towards you, more closer, more shorter. I mean, it's a slow process, but that's how it works. Yeah.
Aside from Alan Greenspan and Class 5 hurricanes hitting, destroying the Gulf states, what kind of bells go off in your, or what things set off bells in your head saying, hey, I think interest rates are going to go up, or I think they're going to fall? What kind of events trigger that thought?
Really the shape of the curve. I mean, do you follow the fixed income markets in terms of the disconnect between short-term and long-term?
Not a whole lot.
I mean, basically you've got Alan Greenspan, who's raising rates, who thinks there's all this hyperinflation in his numbers, which don't show up in the CPI or the PPI. Yeah, oil's gone up, but other things have stayed pretty relatively calm. And then you've got the bond traders in New York and Chicago who are trading bonds who think just the opposite. They think the economy is actually slowing down, which it is. GDP growth is slowing down. So they think, well, if the economy is slowing down, then there's no way interest rates can go up. Because the economy accelerates, usually that means higher interest rates. So those are really the big things you're looking at. So it's almost a daily function, meaning every day you come in the office and you've got all these indicators coming out like, Michigan sentiment, consumer confidence, wholesale inventories, PPI, CPI. So every day there's an event in the market that occurs that either supports or doesn't support Alan Greenspan and the bond market. So the bond market's moving off these events. Like if inflation came out, PPI was above expectations, that means there's more inflation. Then all of a sudden the bond market will go down because that would support Alan Greenspan's thought that there's inflation, which means we have to have higher rates. If the next day, inventories come out and they're not as what people expected and they were showing there's, a buildup in inventory, which means a slower economy, then the bond market actually goes up. So it's a day-to-day barometer of the economy on these economic indicators. So it's got every day you come in and it'll say, well, we think this, we think that. That's why the markets go up and down every day. It either supports or doesn't support it. Yeah.
Why do you think we're seeing that discrepancy between individual indicators?
It's always that way. Ever since I've been in the business. You have like this big macro view, and then you have the day-to-day view, and you get caught up in the minutia of the day-to-day view, and a lot of times you don't even see the big picture because you're so caught up in that day-to-day number coming out and what it means and the implications of it and so forth. It's just the way it's always been. Matter of fact, if you want to follow the stock and bond market, just follow those indicators. Every day they come out, there's expectations. They come out at 8:30 in the morning, the market opens at 9:30, and the market always trades off those numbers. And there's always 2 or 3 numbers a week that are very important for the market. And that moves the market just about every day. Yeah.
Have you ever thought about using, or have you heard other people using alternative investment vehicles for the...
hedge funds?
Yeah, no. What I meant was to take a position in credit instead of just using corporate bonds. Have you ever
I don't know anything about that. I'm sorry. Yeah, that's kind of, you're a little more sophisticated than I am on that segment. I don't know. You mean in terms of when you say credit, what do you mean by alternative credit?
Default swaps. That's what
Yeah, I mean, you're talking about like sophisticated option strategies in terms of your fixed income portfolio, or using futures or something, maybe? Yeah. Large institutions will do it. We don't do it. That's beyond our scope. That's pretty sophisticated. You know, and if you're wrong, you had to pay for that right to do something, or you sold the right to somebody else. So you better know what you're doing, because you can really screw yourself up. If you look at a lot of large corporations, when they take big charge-offs, it's usually because they screwed up on their derivatives. You know, they take a big derivative charge-off. And now with the new accounting rules, where you got to go mark to market on your derivatives, and you got to show it at the end of the quarter, they're having a lot of companies that took big charges on that, and that new accounting rule really hurt them. So that's pretty sophisticated stuff. We don't do that. We just don't. We don't go take it to that level. That's. I know what you're talking about. That'd be really sophisticated stuff. Yeah.
When did you switch from overweight duration to underweight duration? Like if rates were going down a lot after the September 11th, and then eventually they went back up. When did you switch from? Like, did you switch before the rates went back up again, or were you?
Well, I mean, we're probably more of a we're probably more of a follower than a leader. Like, we're not going to put our necks out when the trend is going one way and think it's going to go the other and then be wrong. Usually the trend starts to go, you know, you start to see you read the Open Market Committee publishes their reports. Everybody knows what they're talking about. So you know the sentiment is starting to move towards higher rates. So then you say, okay, let's go below the index to try to hedge ourselves. So it's really no secret out there. Everybody kind of knows what the bias trend is. You know, but you can create scenarios in your mind. For example, Alan Greenspan is going to retire in the next year. He's already jacked up short-term rates. He's probably going to put them at 4%, and the 5-year is under or at 4% Treasury. So literally you have a flat curve from 0 to 5 years. So you could make a case that oil prices may drop, which would lead to a better economy, and that eventually they'll have to bring short-term rates down again to bring the yield curve from inverting, which would be good for stock market and bond market. I mean, that's my prediction. You know, but I'm always bullish. I've been bullish for 18 years. You have to be. You can't get in front of a client and say, well, stocks are going to go down, bond market's going to go down. Do you want to give me $1 million? No. So I'm always bullish. My clients, they like that I'm always upbeat and positive. And I always have these really good scenarios how things are going to come together and work out, and it's going to always lead to higher prices. But anyway, let's talk about equities. We are, like I said before, a top-down. So you've talked before about bottom-up, right? Do the research on the bottom on the companies, and then you bring it up. So you could own all tech stocks if you wanted to, right? Because you're not top-down. We're top-down, so we start at the top, and we'll get into this in a little more detail. We are blend, so we're both growth and value. We'll talk more about that. Basically, what we do is we look at what the street says. We get all the research that everybody has out. You know, Merrill Lynch, Bernstein, everybody. But we do our own work, meaning that each portfolio manager, I'm on the equity research committee, I do utility stocks and tech stocks. And I made my name, and the reason why I get on TV so much is because of tech. Because I started doing tech in 1990 when nobody was doing tech. So when tech took off in the 90s, there weren't a lot of people that would get on TV that knew a lot about it. And that's how I got on TV, because the press loves to talk about tech stocks. They don't care about anything but Microsoft, Intel, Dell, Oracle. And it doesn't matter if the stocks go up. That's what they want to talk about. And but anyway, we do our own work. And we have 5 portfolio managers that are on equity research committee. I'm one of them. And each one has 2 industry groups. And each guy's responsible for picking the stocks that go into our guidance list that we pick from, that everybody buys from. And I'll talk about our sell discipline in a minute in terms of how we use stop losses and so forth. So here's the Standard & Poor's 500. And this is a pretty standard chart. You guys have probably seen this in your textbook, just the performance of it. I think the reason why we bring this out is, believe it or not, the market's up 75% of the time. Did anybody know that? Did you guys know that? So that's why I'm always bullish, because the market's up 75% of the time. It's only down 25% of the time. So I always talk about that, and I talk about the average returns and so forth. This is growth versus value. So, for example, during the 90s, what do you think was the best to be in? Was it growth or value? Growth, right? Everybody owned tech stocks. That's what went up, their growth stocks. After 2000, what did go up the most? Value, right? So this chart, it's kind of hard to see, but this is growth, and the top one's value. And see how this kind of goes along? That's growth. And if you go all the way to the very end of the chart, look, growth has underperformed value after, it's hard to see on the bottom, but after the last, when you push it out over the years. In the last like 3 or 4 years, value has actually outperformed. And you can see this dark line is value. And look how it really beat out in 2000, 2001. So when all the tech stocks got crushed, value was like, whoa, way up in terms of performance. So if we get it up today, guess what? Value wins. Even though I tend to be more of a growth-oriented person because I'm in technology, which is all basically growth stocks. So, but it gives you an idea of the difference between those two different disciplines and who's doing the best. So this kind of talks about, our process and add value, performance. This kind of give you an overview in terms of, like I said, we're large cap blend. We don't buy stock unless it's $5 billion and above in market cap. This talks about risk tolerance, individual needs of the client, and so forth. This is basically our top-down process. So this would kind of go back to what we talked about fixed income. So we look at the economy, which is all the economic indicators, the bond market, inflation, interest rates, what the expectations are, formulate an outlook in terms of what we think is going to happen. Do we think the economy is going to accelerate, deaccelerate? Do you think interest rates are going to go up? Do you think inflation is going to go up, go down? And then basically from that we kind of boil it down to, well, what industries do we think will do the best based on our scenario? So for example, if we think interest rates are going to go up, would you over or underweight in financial stocks? Under. Under. Because financial stocks are interest rate sensitive, and when interest rates go up, the market perceives that banks, insurance companies will not do as well. But in vice versa, when interest rates are going down, they think they'll do better. And the reason being is that when interest rates go down, for example, what happens in the housing market, right? Interest rates go down, everybody buys a house because mortgage rates are lower, and everybody goes to the bank and gets a mortgage. That boosts up the bank's profits. That's why when interest rates go down, bank stocks go up. So let's do another one. If we so think of interest rate sensitive. Let's say the utility sector. Utility stocks, what do? They pay a big dividend, right? That's why most people, your grandmother buys utility stocks because you can buy a big dividend, right? So if I think interest rates are going to go up, what would happen to utility stocks? Think about bonds. What happens to bonds when interest rates go up?
Down, prices fall.
So utility stocks would go down. So you would not want to own utility stocks. So the reason why I give these examples is there's 10 industry groups. Industrial, staples, consumer discretionary, utilities, technology, materials, telco. You got these 10 groups. Each group has a certain weight within the S&P 500. For example, technology is 15% of the S&P 500. Healthcare is like 12%. Industrials are 12%. Consumer staples are about 13%. So what we do is, just like we did with the Lehman Index, we take the 10 different industry groups and we either over or underweight in those industry groups. So based on our economic forecast of what we think is going to happen, if we think interest rates are going to go up and financials represent 20% of the S&P 500, we're 15%. Does everybody understand that? Because we think financials are going to go down, so we want to be less exposed to that group. Right? If we think the economy is going to accelerate, technology stocks do good when the economy is accelerating because companies have more money to spend on computers. So we would be overweighted in technology. If we think the economy is going to slow down, we'd be underweighted technology. So what we do is we take the S&P 500 index and we either over or underweight each sector, and at the end we have 100% invested at all times. And that's how we decide our way of doing it. Yeah?
How high are you willing to go over or under?
I think we're 500 basis points. So if the tech is 15%, I can be 20% or 10%. If healthcare is 12, I can be 17% or 7%. So we, like right now, we're overweighted in energy. Energy is only 9% of the S&P 500. We're at about 12, 13. And we can bump that all the way up to about probably 14%. So if we're right and we say 14% and the market's at 9, we should get outperformance. Our portfolios will outperform because energy is up like 40% this year so far. It's the best performing group. And I'll tell you what, that right there, that concept that I just told you, if you guys can just remember that one thing from this entire discussion, you are so far ahead of every individual investor in the world. Because what do individual investors do? They go out and they think stocks. You know, the guy at Merrill Lynch, he hears a stock on CNBC and he puts it in his account. Then he goes to the grocery store and he sees something he likes, he puts that in his account. Then he goes on vacation, stays in a hotel, he thinks it's great, so he buys that stock. Before you know it, he just has a bunch of stocks, but he has no allocation. He's got like all his money in consumer staples, industrials, and technology. He doesn't own utilities. He doesn't own, all the other sectors. So the goal is you start off with all the sectors, and then what you want to do is you want to put stocks in each sector. Just fill up each sector, and based on what sectors you think you do the best, you either put more or less stocks in those sectors. If you guys can conceptualize that, along with my example of the benchmark on the Lehman, you guys could all become portfolio managers by just leaving here. You wouldn't even have to take any more finance courses. That's all we really do, is just either over, underweight, and put those groups. So apply our economic outlook, analyze industry groups based on competition and consolidation, forecast performance, and then we boil it down to the company. What we basically do is, as I said before, we have an equity research committee. We meet twice a week, and each guy has 2 industry groups, and it's his job to make recommendations to the committee, and they either reject it or accept it. So, like, for example, I may come in next week and say, I want to buy Motorola and Texas Instruments, and these are the reasons why, and I write a 2-page research report on both stocks, and I send them out to everybody, and then I tell them why, and then they say, no, I don't like Motorola, or yes, I like Motorola, yes, I like Texas Instruments, and we either put it on the list or we don't put it on the list, and that's how we do it. And then we may say, okay, you're the guy who handles telecom. We're going to reduce you from 4% to 3%. We have 200 basis points. I'll take 100 basis points in tech. So I go from 14.5 to 15.5, and he's the healthcare analyst, and he's at 16%. He gets 17%. He's got 100 basis points. So you come up with a new stock next week, and we'll put it in there 100 basis points. That's how we do it. That's how we manage the portfolios. We have a core list. That's about 30 stocks. That's how we grade our performance. And then we have about 100 stocks that we have, which is on our overall list, which you can buy off of, but it's the core that we judge our return on. So that's how we boil it down from the top down to the industry, down to the company, and how we actually pick our stocks. So this talks about...
Anything like that 130 is off limits, your people can't buy it.
Say that again, sorry?
Anything off the 130 names, your people
you
can't buy
it. You have
it.
to get approval. It's about 100 names on the big list. The core is about 30 names. You have to send it into, actually, the CIO will approve it or not, because it's out of our control. We don't want to be responsible if you are a rebel. You want to go buy your own stock. Because if you're wrong and it blows up, then you can get sued. This is kind of just a thing between fundamental analysis, quant analysis. I'll talk a little bit about our sell discipline in a minute, too. This is kind of step-by-step process. So in terms of boiling it down. So we talked about going into the industry. There's 10 industry groups. Kind of doing our growth analysis. Looking at earnings, sales, dividends, cash flow growth. These are all just kind of variables from your financial classes. Strength in terms of those different issues in terms of the statements. Qualitative issues. For example, if you guys decide to become portfolio managers and analysts, it's really not finding out what's right about the company. It's like finding out what could go wrong. Because when it goes wrong, it's really bad. Because the stock can get crushed really quick. So a lot of the time is spent what I call uncovering the stones, which is trying to turn over every bad thing that can happen and understanding it so that if it does happen, you're prepared for it. For example, if you've got a company that only has 3 major customers that account for 60% of the revenues and they lose a customer, you're going to get crushed. Because the earnings and sales are going to come down. You're going to get destroyed in that stock. So you need to understand that about that company. And I'm just using that as an example whereby in every different company, it's almost like you're looking for what could potentially go wrong. Like, do they have an underfunded pension fund where they may take big charges? Are they a company that acquires a lot of other companies, so they create a lot of goodwill, and they're going to have to amortize that goodwill on future charges, which is going to destroy earnings? So there's all these different things that you look for in terms of what could potentially go wrong in the future, and that's a lot of the kind of qualitative stuff, and also the risk element in terms of what's going on. And obviously, we're looking at margins, operating margin and gross margin, net profit margin. Are they expanding? Are they contracting? And different things. And then, of course, valuation. You guys are all familiar with price to earnings, price to sales, PEG ratio. We look at all that just to get an idea where the stock's trading. On the Bloomberg, it gives you a five-year trail. on all those different variables so we get an idea where the stock's at, whether it's a good value now, it's over or undervalued, and that kind of stuff. Sometimes stocks can be overvalued and it doesn't matter, they just keep going up. Like Apple, just keeps going up because everybody's buying iPods. That's one stock that I got on the list and it's doing great for me. Might as well talk about all my winners because, you know, it's my show here. But I don't tell you about my stocks that went down. But that's an example of stock that's overpriced. It's trading all ahead of all the PE, price to sales, price to book. Doesn't matter. It's going up because people want to buy iPods, and it's going up. Yep.
Or do you try to do an intrinsic value of the company and try to set a target price that you would sell the company at?
I mean, that's intrinsic value, meaning that this is what it should be priced at based on these things that I've analyzed. You can do it. Be honest with you, target prices are, for Wall Street can say the stock is at 35 and the target's at 60. You need to buy this stock because it's going to go up. And what they do is they project an earnings number, right? $1.50 in 2006. They take a PE, a market multiple, and they project the target price. An intrinsic value is another way of saying a target price. An intrinsic value would be something that you might use more in a value approach than a growth approach. For example, the real estate and the pension fund and the cash in the company has a higher intrinsic value than does the actual value of the company. Therefore, the company is valuable. That might be something that you could work with in that terms. But we don't do a lot of that. It would be kind of digging around and vulturing and digging them, like the airlines, right? We said Delta did Chapter 11. U.S. Airways is Chapter. I mean, all these companies are going Chapter 11. So if you're like this real sophisticated value guy, maybe you could go in and delve through all their assets and all their planes and routes and figure out that the stock's worth $5 instead of trading at almost nothing right now. So that might be an intranet, but we don't do that. We're more, if our market cap's $5 billion, so we're never going to be down in that vulture land looking at these beat up things. But you could do that. There's guys that make a living off of that kind of analysis, but we don't do that. Yeah. So this is kind of another, what we talked about before, intrinsic value, discounted cash flow. We really don't do discounted cash flow. You guys probably did it in school. I talked about it with some of the guys upstairs. What's the biggest problem with discounted cash flow? You got to know this. The discount rate. If the discount rate's high or low, you get these huge variations in the target price, which make it very difficult to come to any conclusion. Really, discounted cash flow is used in merger and acquisition deals, in investment banking. They'll do like a projection of the cash flow of the combined company and discount it back and say the stock's worth this, so we got to do the deal. But we don't really do too much of that. Relative valuation, assessing security value by company ratios. A lot of this is kind of redundant to what we talked about in the previous slide. Some of the parts you probably heard about. That's analysis I just gave you. If I break up the company and I take the airline, I take its hangars and planes and routes and I break it up, it's worth more than the stock price. So I buy the stock. That's kind of the sum of the parts type of theory. This probably goes back more during the 80s when they had the big arbitrage deals with the leveraged buyouts and the junk bonds. A lot of this sum of the parts was reasons why they did a lot of those deals. Okay, so let's talk about sell discipline. Everybody wants to tell you about, I did all my analysis and I did this great work and I picked the stock and it went up and I made all this money. The reality situation is that doesn't always happen. Stocks go down. And the biggest part of really being, I think, good as managing a portfolio of stocks is knowing when to sell a stock. And basically my discipline is the following. I put either a 50 or 200-day moving average target price underneath that stock, and depending on whether it's a super volatile stock, if it drops below that, I just sell it. And the reason being is because I've lived through 87 and I lived through 2000. And I saw stocks go from 50 down to 5. And there's nothing worse than getting in front of the client and you keep saying it's a good stock, it's going to go up. Your Nortel is going to come back. Your EMC is going to come back. It's at 100, now it's at 10. It's going to go back. I'm not going to have those conversations. If EMC is at 100, I'm out at 80. I just sell the stock. Thank you very much. Even if I just bought it, I'd rather take a 10, 15% loss, get out, and that, so you got to understand, think about the mathematics. If you have a stock goes from 100 down to 50, how much does it have to go up just to get back to where you got it before? It's got to go up 100%. How much did it just drop? 50%. Think about those numbers. Every time you go down, you got to go up that much more with less money in the market. So basically, my sell discipline, the sell discipline that we use on a fundamental basis, which I'm going to talk about in a minute, the one that I use is I actually have every stock that I own 100 stocks at least, is on my Bloomberg, and I have alerts that go off, and I actually have an alarm that goes off and blinks when that stock hits that sell, and I go and I pop it up on the chart, and I look at it, doesn't look good, I just sell it. And I've had stocks like Harley that I sold. I've had stocks that have gone down, and I kick them out, and they kind of come back up again. But you know what? The client doesn't even remember that. All they remember is that you didn't sell it, and it went down, and kept going down, and you kept losing money in that stock. And you'll lose clients over one stock, like Tyco. How many people, Tyco's at 60, it dropped all the way down to what, below 10? I think it's back up to 20. Enron. You know how many people got blown up in Enron? If you owned Enron and you didn't sell that stock, I guarantee you'll lose that client. They're like, what are you doing? I'm paying you to look at this company. Why am I paying you this fee? You're supposed to know that this is going to happen. I'd rather sell Enron out and lose 15 points and watch Enron go down to nothing and try to sit in front of the client every time. What about my Enron? What about my Tyco? What about my EMC? Why didn't you sell it? So that's why we have the stops. The other way that we sell stocks, obviously, is fundamental breakdown, but you know as well as I do, when you get the internet, the fundamental breakdown already occurred. The stock's down 10 points, you already lost it. But if you start to see some indications, for example, the stock starts to weaken, you're like, uh-oh, what's going on? You dig into the financials a little bit, you notice that the margins are coming down, or there's a fundamental change in what's going on in their business, or something's happening that's preventing them from doing well in the future. We'll sell the stock based on that. We'll also sell stocks on what I talked about before in terms of our change in our rotation, meaning if we then decide to underweight in a sector, we'll sell a stock in one sector and buy stock in another sector, or we'll pare down on a stock in a sector. So that kind of gives you an idea of some of the other things that we'll do. And then obviously the best case scenario, you buy it at 10, it goes to 100, and you sell it, right? You take your profit. That never really happens, to be honest with you. Reality situation is if you've got your winners in your portfolio, you think they're going to keep being winners, and you usually don't kick them out until they come down again. So you buy stock at 10, it can go to 100, you got your stop that's trailing under it, and it hits that stop, you kick it out. Very rarely is anybody smart enough to buy a stock at 10 and sell it at 100, and then it goes back down to 10 again. I mean, if you can do it, that's great, but there's not a lot of people that are that smart.
15% below the 200-day
About
moving
15%. Yeah, well, no, 200-day moving average is the one that I'll usually set it around the 200-day if it is a volatile stock, like a tech stock. If it is a less volatile stock, I'll usually set it under the 50. And I won't just kick it out automatically. If it hits it, I'll go and look at it. Try to, obviously there's some news out, something's going on that's leading to the weakness. And then I'll decide based on what the story is whether I think it's a viable reason to sell the stock.
You have to then go to the committee? Or
No, I kick them out on my own. I kick them all out, yeah. So any other question on the sell? Sell's huge. Everybody's talking about buy, but if you get a good sell discipline, stick by, you'll do well.
Do you trade in-house, or do you
We have all the I have a trading thing that sits on my desk, and I put the trades directly in the accounts, and it goes down to our trader, and he gives it to different brokerage firms on soft dollar. Then we get research from Merrill and Bernstein, some of these other firms. So we push the trades through them, and they give us compensation back for doing the trades through them. But I don't get involved in that. I'm not a trader. I'm just a portfolio manager.
Is your sell discipline different for taxable versus tax exempt?
It is to a certain extent, meaning that if you've got an IRA, which is tax-free, an IRA account, you pay no taxes, you can be a little more aggressive, maybe put some more volatile stocks in there like biotechs and techs. So if you get a nice move on the upside, you can sell it, not take the big gain. Whereas you may be in a more regular account or a trust account, you're going to be, more or less conservative. A lot of the money that I handle is either I sold a business, you take care of it, I want you to manage my money, I don't want to deal with it, or it's somebody that worked all their lives and built up this huge amount of money, and they give it to you, and it's everything, and they can't afford to lose it. So when you start talking about sell disciplines and preservation of capital, it's like bing, 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 that hits them hard. And also, preserve on the tax side in terms of, making sure that you're not going crazy. Because our turnover is only about that of the S&P 500. It's probably about 15%. We don't have a lot of turnover. We're not traders. We buy stocks, hold them over long periods of time. If there's a problem, we kick it out. But we're not like when these guys, buy Apple, hold it for a week, sell that, buy Microsoft, kick that out, buy EMC. We don't do that kind of stuff. Any other questions or? Okay. So what do I get next? I think that's pretty much it. Why don't I talk a little bit, he introduced me, but let me just talk about kind of my career a little bit and maybe help you guys kind of decide like what you want to do. And I'll talk about how I got into it. And I'll talk about maybe the differences between being a portfolio manager, an analyst, or an investment banker. Would that be useful? And then you guys can maybe from this kind of decide what direction you want to go or what direction you want to pursue or get more information. I graduated University of Florida December of '85, got out for a year, about 6 months, did nothing, didn't know what I wanted to do, had no idea. I'm from California, so, you know, I went back. I went back home, I went out, I lived in Manhattan Beach area, you know, I didn't know what I wanted to do. And then I came to the conclusion you can make a lot of money in the market. So I said, okay, I'm going to go do that. So I went to New York, and that's where I started. I started on Wall Street. I worked with Kidder Peabody, which doesn't even exist anymore. I worked on 10 Hanover, which is in downtown New York on Wall Street. And I went through their program. They had a equity, you know, institutional sales program or broker program, and I went through that. It was like a 6-month program. Completed that. So if you want to, I mean, the reality situation is, and it sounds really bad, there's not that much going on in Florida other than being a broker. You know, you go to the Merrill Lynch office, you get a job, you're a salesman, you're a broker. If you want to get on the portfolio management, on the analyst side, you're going to have to pay your dues somewhere. You're going to have to go somewhere and just not just be a broker. And the opportunities are, you know, New York, Chicago to a lesser extent, but mostly New York. And I think it's a good experience. I mean, I've been all around the United States. I've lived in a lot of different areas. So it's no big deal for me to just go up and move to New York, get a job, work for a couple of years, get some experience. So I started up there. The market crashed. There were no jobs. MBA. So I said, let's go back to Florida. It's warm. So I applied. I got in U of M. Didn't want to come back. No offense to U of F, but I already had a lot of the courses were redundant back then in their MBA program. So I went to university. I was in a big city. I was like 25, 26. I'm like, I don't want to go back to Gainesville. You know, I can be in South Beach. And so I went down to Miami. So I did the MBA program down there. And then by getting the MBA, you're then qualified to be a portfolio manager and analyst. If you don't have an MBA, it's really hard. Or get the CFA, and that's like a 3-year long program. Takes forever. You got to study every night of the week. I'd rather get an MBA in a year and a half or 2 years, and then you're qualified to get into that. So then I got into portfolio management. I also worked as an analyst. I followed about 5 or 6 different companies on the sell side, which meant that I wrote 10-page research reports about stocks, and I had a model that projected the earnings out, and I had institutional salesmen who would call up mutual fund portfolio managers and tell them about my stock, and they would buy the stock through us, and I would get a piece of the they'd buy it, 15 cents a trade or whatever the share amount was that we negotiated, and then you get a percentage of the money that comes in from that. Being an analyst is different than being a portfolio manager. You are totally responsible for that stock. You have to be the ultimate authority in terms of that company knowing everything about it. You're going to have institutional investors who have huge positions in your company that you're recommending, who are going to question you on every element of what you're doing, and are going to know almost as much as you do about the stock because they have so much locked in this company that if it doesn't work, they're screwed because they're going to lose all their clients. So kind of gives you an idea of what's it like to kind of be on those different sides. As an analyst, you also will go with the company in front of investors that are portfolio managers of large mutual funds, and they'll pitch the stock. They go on these road shows, and they'll talk up. You'll have the CFO and the CEO up there with his big slideshow saying we're the greatest company in the world, and then you're the analyst sitting on the side. And they'll ask you the questions on the financial side, and they'll ask them about their company and so forth. That's what you do as an analyst. And you have a model. You send your estimates into Zacks and Bloomberg, and they get that consensus estimate. You're part of that consensus estimate, and your job is to be right in terms of projecting the earnings. I will say one thing, if you're an analyst, you're usually very bullish on the stock. And the reason being is because you get paid to recommend the stock, because that's when people buy the stock, they buy it through you. So that's why I have a bias, like 80% of all stock recommendations are either a buy or a hold. You have very little sell recommendations because Wall Street is driven to create buys on your stock. So they'll buy through you. So that's what an analyst does. I'm sorry, go ahead.
Can you just talk to us for a minute about what you think about all this continued emphasis on the quarterly earnings projections and the consensus estimate, and
right.
Just this, to me, almost mindless.
Yeah. When he talked about intrinsic value, in regards to a company, which is a good point, because what is the true value of a stock price, of a company at a given time? Wall Street is 100%, I don't care what you can study all the variables you want, operating cash flow, price to book, all these different things. All they care about is earnings. They care about what you reported and what the estimate was and how your different business lines fell into their estimates. Either they're above or below. If they're above, your stock goes up. If they're below, it goes down. And even if you're above, the stock can go down because you have people who take profits when the news comes out. They'll sell into the good news, and they already bought the stock a week ahead in anticipation that it would be good. So Wall Street is 100% focused on earnings estimates. That's all they care about, and how the company's doing and so forth. Did you exceed or fall below or above that estimate?
It seems.
It might not be right, but that's how it is, unfortunately.
Right, I know.
Yeah. Well, let me talk a little bit about investment banking, because I think those are and I'll circle back at the end about portfolio management, because that's what I do now. Investment banking is basically, if you've got the portfolio managers who are holding the stocks, you've got the security analysts who are writing research about the stocks, the investment bankers create the stocks. That's the best way to say it. So what they do is they go out and they take companies public, right? You got a private company, and it's not trading on the exchange. They go and they do the deal, and they issue shares. And that's basically what investment bankers do. They do other things like private placements and other more sophisticated things. They'll do mergers where they bring two companies together and they negotiate the deal. In terms of being an employee, if you decide to get into investment banking, you got to go to New York, first of all. Number two is you start off as a grunt, meaning that you will work your ass off and you won't get paid a lot of money. You'll work weekends, you'll work late at night, you'll be the peon of the organization for years until they eventually say, okay, you can become one of us. And the guys you work with will have egos like this. They all think they're God, and they think they're the smartest guys in the world, and they all hate each other, and they all work together. That's my best. You can tell I love investment banking. But they make a lot of money. They make tons of money. I mean, if you're a successful investment banker in New York, you'll make millions of dollars a year. There's no doubt about it. But, I mean, that's the very few that are able to do that. You always hear about them in the Wall Street Journal. There's a million other guys trying to be at that level. But it's a very hard way to go. Portfolio management, which I do, and I've done all three. I worked as an internship when I was in graduate school in investment banking, decided I didn't want to do it. I did the analyst. And the reason why I'm in portfolio management is you get a nice salary, you get a bonus. You don't have to work that hard. I mean, you come in, the market opens at 9:30, closes at 4. You don't work weekends. You come in at 8:30, you leave at 5. You don't have to kill yourself. You make a very good living, and it's not, and it is challenging within itself in terms of picking stocks. I enjoy picking stocks. That's my love, and it's challenging in terms of trying to beat the indexes and put together portfolios and that kind of stuff. So everybody's got their own loves and stuff. Has anybody here ever come and talk about consulting? Because consulting is very similar to investment banking. Yeah, consulting, if you go work for a consulting firm, be very similar to working as an investment banker. And then I guess on those rings, if we were to break it down, portfolio management, analyst, investment banker, and then the lowest level would be a broker, which is basically a salesman. And there's nothing wrong with doing that. There's nothing wrong with being a broker. I started off as a broker, and sometimes you have to start off that way to get your feet wet and decide that's what you want to do. And you can make a lot of money as a broker. You could be a commission-based broker and make millions of dollars a year. Most of those guys are really good salesmen, more than they are on the analytical side. And I'm thinking if you're getting an MBA, that you're more of an analytical type like me, so you're more interested in the numbers and crunching things and coming to different determinations. You probably wouldn't make a good broker, because brokers are on the phone, they're selling, they're good with clients, they like to take people out to lunch, and that's what they're good. I'm not good at that. I'm not that good with people, so I never would make it as a broker. But portfolio management and an analyst position would be something you could do with an MBA or a CFA if you're interested in it. And get your feet wet. Start off as a junior portfolio manager or junior analyst, and then kind of decide what direction you want to go. You could start off as an analyst and always become a portfolio manager, because if you're an analyst, you learn a lot about the individual companies, and you can then take that information later on down the road to be a really good portfolio manager, because you're putting the money on those companies that maybe you used to be an analyst on, or you know a lot about the industry. So, does anybody have any questions about that? Oh, I'm sorry.
In terms of lifestyle and skills and things of that nature, what would you say are the big differences between like the guys under the portfolio managers, the buy-side analysts, or the junior analysts, and the sell-side analysts?
Sell-side would be what I described earlier. I have 5, 6 stocks that I write research on, that I have a model on, and I have 10-page research report on. And I have him as my institutional salesman who's on the phone to the portfolio manager of the mutual fund companies, and you are a sell-oriented research analyst, meaning that you're not afraid to get on the phone with the portfolio manager over at Fidelity who's running a $1 billion fund at Magellan or whatever, and he's got your stock and he's knocking you around. You're not selling him, but you're trying to paint a very good picture about your company. We're on the buy side, which is what we are. We're more on the defensive mode, like, well, we just want to make sure that's a good stock and it's going to go up. So let's turn over all the stones to see what bad things can come down the road to prevent an implosion, that stock going down and hurting our client and our portfolios. So we're more of like in a defensive mode where we're researching stocks and trying to be more careful to make sure that it doesn't have a problem. Where the sell side guy is more like, yeah, buy my stock. And he gets a percentage of the revenue that comes through on his stock. So he's more driven that way in terms of his salary.
So the junior analyst would be doing the...
Junior would just do, if you think of the buy-sell guys is what I just described, then the junior guys would just work under an analyst who's doing that. So you might be, if you're under a sell analyst, then he's handling 6 stocks and he's got you doing the grunt work behind those 6 stocks, digging up K's and Q's or calling up a manager or calling some competitors or doing some industry research to help in his research reports that he's doing and so forth. So that's it.
Do you believe you can draw a distinction between a research analyst and a portfolio manager?
Well, we are kind of a combination of a buy-side research analyst and portfolio manager, and then there's various degrees of that. You have guys that are more on the analysis side and run portfolios, and then you got guys that are more on the research side and less on the portfolio. But there is that line that kind of teeters between the two. The only one that would be separate is the sell side. Sell side is a sell side analyst. He's got his stocks and he's trying to sell that stock. So yeah, there's, it's like you could say, like when I describe my job, I would say a third of it's marketing, which is getting on TV, doing seminars, getting in front of clients, getting in front of board of director meetings. A third of it is analysis, finding out what industry group to be in, finding the stocks to buy, and then a third of it's managing the portfolio, which is what the sell discipline, asset allocation. That's the best way to describe what I do. I'm like a third, a third, a third. And almost every job you do, you're always going to have marketing because you've got to always get clients to go with what your idea is. And you've got to be able to get in front of people and talk about what you're, what you want them to do. In any element, investment banking, portfolio management, everything is really, and it boils down to some element of marketing and sales, but not the, used car salesman type of guy.
You talked about both investment banking and sell-side research. That I know the stereotype is to go to New York City to do both of those things. What's your perception of kind of buy-side opportunities in the Southeast?
Well, like Atlanta, any of the banks, I think that you could, anytime you would have a fund, like a money management fund or a trust group or like we are money managers, that's your buy side in terms of, guys cranking numbers to make sure the stocks are good that go in the portfolios. I think those opportunities would be more prevalent. Like, to me, if I said I wanted to stay in like Atlanta, Miami, Orlando, Tampa, kind of that southeast thing, portfolio management would probably be your best bet. Because wherever there's money, it's got to be managed by somebody. You've got to have a portfolio manager. You've got to have somebody who's looking at those stocks. Whereas sell side, you've got little sell side shops all over the place. They're there, but it's just not as, I don't think it's something you could come out of school and say, I want to be a sell side analyst. You'd have to go to New York, work under a junior for a couple, 3 to 5 years, get the experience, get a reputation, then go and get assigned some stocks. You just can't blow out and be 25 years old pitching some guy at Fidelity with billions of dollars who's 50 years old, who's managing this money, he's going to rip you up because, you don't have the experience.
But on the buy side, do you similarly believe you have to pay your dues in New York, or do those opportunities exist for India?
Sell side, probably, there are some sell side, buy side. Buy side still, like I said, it's not as prevalent, but it would be more prevalent than the sell side on the Southeast. There's not a lot. I think most of the opportunities would be like as a junior portfolio manager, working for a trust or a money manager and trying to work yourself up. And if you have an MBA and you're working towards a CFA and you make a case that you're really interested in this and kind of working. I know Synovus, we just moved 4 guys in as junior portfolio managers. They started off as, one was a trader, fixed income trader, one was an equity trader, and they want to become portfolio managers. They want to be traders anymore. So we just promoted, I think, 4 people to junior portfolio managers. So now they work under a guy like me, and they're, been out of school maybe 3 to 5 years, have got some experience, and now they're going to start actually handling accounts. And that's how you kind of work your way up, and then you become a full portfolio manager, and there's different levels, from that. And then as a portfolio manager, you would take on the responsibilities of a buy-side analyst like we described today in terms of picking stocks. Because you have to understand, most money manager firms, they have a methodology for picking stocks. So inadvertently, they are buy-side analysts, meaning they have a model and they're doing analysis. And when they get in front of a prospect, that's what they're pitching is our method. And at the end, they always put up their returns. Look, we beat the index by 200 basis points, so you should hire us because we're better than the index. So that's kind of the art. But I still think if you get out of here and you can't get anything going in the Southeast, you go to New York, you get a job because that's where the opportunities are. That's what happened to me. I mean, I couldn't get there weren't a lot of opportunities in Florida at all when I was looking. So I just said the heck with it and just moved up to New York. I'm like, I know where the jobs are. They're up there. If you want to be, if you want to be in the investment industry, that's the center of the world. So that's where the jobs are. And this, like I said, you go up, you work a couple of years, get your feet wet, and you always have an advantage over everybody else. If you say, look, I used to work on Wall Street. It's like, whoa, wow, you're a big shot. Instead of saying, well, I'm out of the Orlando office. You know what I mean? They think you're a big shot because you're out of New York. Yeah.
Do you consider assets in any other markets like real estate or commodities or international markets or most
REITs on real estate. We own real estate investment trusts. International, I told you before, small cap international, we delve out to funds because we just don't have the expertise. What was the other one? Commodities? Yeah, we don't do anything. He was asking about that. We don't do much with commodities. No, that's pretty sophisticated stuff. That would be beyond our scope. And that markets aren't as big as fixed income and equity, so there's not much demand for us to be an expert in it. But it doesn't mean it doesn't exist. But I know when you're in school, you learn about all these different things, but it all kind of boils down to fixed income and equity. Anybody else have any other questions? Okay.
Would you say a lot of your duties consist of using Excel models, or?
We use Excel in terms of doing breakouts on different things. I'll often put together little models and stuff that I'll do on different stocks or different industries. Like I recently looked at the utility industry, trying to see whether the utility industry was either over or undervalued based on the current earnings growth for that year. So, for example, if the earnings growth of the utility industry was 5%, what was the average price to earnings, price to book, price to sales, versus if the earnings growth was 10%? And then trying to determine where earnings growth is going to be next year, what does that mean for the valuation? We don't get into a lot of super sophisticated stuff that you might use on the investment banking side or if you're an analyst, you're going to have your model, which is basically your income statement. If you're an investment banker, you'll have a model that you'll pump stuff in to determine whether this is a good or bad deal. So if you're into modeling or doing quant type of stuff in a computer, you probably would be more geared towards a junior analyst with an investment banker, because there's guys that's all they do. They just sit there and crank stuff in models all day, and then they tell the guys, the investment bankers, whether it's a good or bad deal. Probably more than what I do. We don't spend all day sitting constructing Excel models, but we do to a certain extent. Any other questions? Yeah.
Say I'm like a pension fund and I have $30 million to put in your direction.
Right.
What's the process of getting that money into one of your products? And then maybe what's like the time it would take me to actually 5 months before I could get the money to you and you're already fully invested? How do you deal with that?
Okay, you're taking away from being a pension fund just $30 million that came into the account. Yeah, basically what I do is I actually buy the stocks over about a 2 to 3 month period, because clients don't like when you put this money in all the next day. They're like, oh my God, you spent all my money. So we do throw 10%. Next week I go to the account, throw another 10% in, throw another 10% in. So it builds it up over time. Then after about 2 to 3 months, you've got the portfolio. That's how I do it. And I just do it because the clients don't like to see you do it all in one day. I could literally put all their money in one day. I could just buy all the bonds and all the stock and say, okay, I'm done. But they like to see you kind of, and you tell them, well, I'm finding that perfect entry point, when really you're just, it's Monday, I'm in your account, I'm in, next, and I've got all my new accounts that I go through on one day, and next day I'm doing research, next day I got to do a presentation. It's just the way it works out, but that's how it's really done. I mean, if a stock pulls back, I'll try, okay, let's buy that because it's off a little bit on our list, but that's usually how we do it. And we work it in over about a 2 to 3 month period. So, yeah.
You get clients?
Yeah. Oh, yeah, I get clients call me open accounts, yeah. Because I do power lunch about every 3 weeks. I was on yesterday at 1:45, and I opened an account down in South Florida off of one of my things. The TV's huge. Just a funny story. When I first got started in the business, I thought to myself, if I could be on TV, I would have made it. And I used to watch CNBC. And I finally got on there. It took me about 7, 8 years to get on. But once you get on, it's huge. It used to be bigger when CNBC was really big in the late 90s with the tech stocks. I used to have people like running me down in the malls, asking me questions about tech stocks. And I'm like, who are you? Because they would see me on TV, because I did Tech Tuesday for 4 years, and I was on their rotation. I was on like every 3 months. So once you get it, plus I had local TV I was on. So, the whole media thing was something that I kind of created on my own. I have 175 media contacts, and I know how to solicit the media to get in the media. And that's something that's unique to me that I developed over the 18 years I've been in the business. No one else in my firm has the media contacts that I have. And the reason why I developed it was because I knew that it would be a credibility booster in terms of raising the credibility of the firm that I work for, and it would raise my credibility. And the big guys at my company just love the fact that we're on CNBC because they could never get on CNBC.
Strategies that you use
to get in the media? You really want to know? Well, I'll tell you how I started. I started off, you guys could do this. I started off writing little snippets on the market, and I would send it to Barron's. Like I would write a little snippet like, I think that this and this and this and this is going to happen in the market because of this, this, and this. And I would send it out to all the newspapers. Like I was down in South Florida, I would send it to Miami Herald and Sun Sentinel and all those guys. And all of a sudden, I got a quote in Barron's. All of a sudden, a little snippet. Dan Morgan says, blah, 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 blah. And I took that and I stapled it to my next snippet, and I sent it to all the local papers. And I said, I'm in Barron's. Oh, this guy's in Barron's. We got to put him here locally. So then I got the local newspaper clippings, and then I took that and I actually sent it to a radio station. And I got on the radio, and I started doing radio. Every morning I got on the radio. I did talk radio in the morning. I did radio. I had 7 years I did talk radio every single morning. And I just talked about stocks. I just talked about what's in the news with the companies, blah, blah, blah. And then I started doing local TV in South Florida and did a couple clips. And then a client of mine said, you'd be perfect for Tech Tuesday on CNBC because you know so much about tech stocks. So I sent a clip up to the producer at Tech Tuesday, and they loved it. They put me on Tech Tuesday. And once I got on Tech Tuesday, I got on CNN Moneyline, and then I got on Nightly Business Report with Paul Kangas, and then it just exploded. Then Bloomberg, and I used to fly up to New York, and I would do Moneyline at night, and then I'd wake up in the morning, do Tech Tuesday at 6 or 7:30. Then I'd go shoot Bloomberg, and then I'd shoot another TV show, and I'd fly home. I would do 4 interviews in 24 hours, go up, do a big media blitz in New York, come back. And then once they got to know me, then I did everything satellite. Now I do it all via satellite local stations. And the whole key to getting on is to give them what they want, not what you think you're good at. So, for example, the reason why I got good in tech stocks is because that's what they want. They all wanted to know about tech, so I immersed myself in becoming an expert in technology stock. So whenever there was a story on tech, they'd say, oh, we know Dan's great tech, so they put me on. So that's how it got going. So if you want to become a media person, just find out what they're talking about and become an expert in what they're talking about. Like, become an expert in the Florida-Tennessee game. They all want to talk about it. You can talk about that tomorrow or today because everybody wants to talk about it. That's how you do. You just give them what they want. And then after a while, every time I'd get in, I'd put them in a database. And then what I do is I have a database of all these different people with the Wall Street Journal, the New York Times. And what I'll do is if I know there's a big story coming out on a stock, like Microsoft's going to report earnings, I'll send out an email to 170 people saying, Dan Morgan is expecting this out of Microsoft. Earnings are going to be up 5%. Xbox is going to sell 5 million units. I just make up all, I put it up there, I shoot it out, and I'm like, oh, I'm doing a story on Microsoft. I got to call Dan Morgan. And they call me up, and they interview me, and they put me in there. That's how I do it. But, I mean, that's like secret stuff. Even the portfolio managers don't even do that. That's my own little thing that I created, the whole media thing that I created. Like, I'm a big deal, even though I may not be. But if you think you are, and you pitch it to them, and because the last thing I do is call up CNBC and say, I want to be on CNBC. Can you put me on tomorrow? They're like, psh, they'll hang up on you. But if you build it up over time, a little couple newspaper clippings, get a little bit of radio, a little local TV, send them up a thing. And the first time I got on CNBC, I was so scared. They put me on. I was like, because you're sitting in there, and you're sitting in this big black room. They got the cameras on you. And the guy that was supposed to be on with me didn't show up. There was another guy from Payne Weber, and it was supposed to be a split screen for 6 minutes. I got the whole 6 minutes. And I'm like a deer in headlights. And I was like, I was on Liz Clayman. I don't know if you guys watch CNBC. Now I do it with Bill Griffith, who's on Power Lunch. But that's who interviews me now. But Liz Clayman interviewed me the first time, and I thought I did really bad. And they, we loved you. You were great. And that's how I got on with CNBC. Then I used to go up and do Moneyline with the names. Who's doing Moneyline right now? The big Dobbs, Lou Dobbs. There was Lou Dobbs, and he got fired. And then they brought in another guy with dark hair, the English guy. And I got on with him. And then once I got on with him, I got in good with a couple of the other people there, and they started getting me on CNN with Moneyline. And then Moneyline switched their format. They're no longer talking about stocks. If you listen to them now, they just talk about terrorism and stuff. So I'm not on anymore. But when they were talking about tech, that's how I got on Moneyline. So it's almost like find out what the market's interested in, become an expert in it, and just start sending stuff out, build up when I'm at the airport and I'm bored, I'll go over the magazine rack and I'll look up all the business journals and I'll write down all the names of the staff writers. And then once you break the code of their internet, that internet, all the Dow Jones writers, it's at Dow Jones. So I'd literally go, okay, your name is this, at Dow Jones. And I would put them in a database and I would just send them out, blurbs. And some would come back, wrong email address, but 50% come back that they're getting it. Then all of a sudden somebody gets it and they're like, boom, I'm writing a story on that stock that you just sent me an email on, and they put you in. That's how I got Investor Business Daily. That's how I got Wall Street Journal. I got in by doing that. And Barron's. All those. And now I've got this huge, massive database of all these guys that I've accumulated. But that's how I did it. I mean, I don't know if you guys want to do that, but that's how I did it. A lot of guys have to hire PR firms and pay them $5,000 a month to get them on TV. I did it all just through doing that kind of stuff. But that's a unique situation. I don't think you'll have many people coming through here that do all that media. I do about 5 interviews a week.
The stock and you determine that it's bad, do you engage in short selling or do you stay away from that?
No, we don't do short. The problem with short selling is, you guys know what margin is on accounts? You're 50% margin. Short selling is just the opposite. You have to borrow the stock from him. I have to borrow Microsoft at 25, and I'm paying interest on that stock. If it doesn't go down, I got to keep paying him interest, which each erodes into my profit. So theoretically, you have to be really right on shorting, opposed to being long. Because long, if it's at 25 and it sits at 25, does nothing, you don't lose anything. But if you're short, you have to borrow the stock, you have to sell it. If it doesn't go down, you're paying to hold the position. So it's very costly, and you have to pay, you have to pay the rate, and it eats into your profit. So we don't short. But I mean, you could short. If you shorted 2,000, you would have made a killing. But who all knew that was going to come after such a huge bull market through the 90s? Any other questions? Yep.
How do you handle client policy? Like if they write a policy and they don't want you to go more than a certain percentage in fixed income?
They do that. I build each one individually. Like I have some clients that will only allow me to buy A or better stocks. I have some clients that I can't go more than 50% in equity. I have some clients that say, don't buy me tobacco stocks. So you just have to take into account each client investment policy statement. Usually that comes from a foundation like a church or a board of directors will put together an investment policy committee, and they'll formulate what you can and can't do in the account. And then I just have to follow that, what they tell me to do. But that goes back to what I said before about how we do individual management, and we just don't do a cookie cutter type of thing. And that's one of the sales points that we make at our company when we're in front of prospects. We'll say, well, we're going to give you a customized portfolio. So if you have specific instructions of what we can and can't do, we'll follow those instructions, where the other firm's just going to kind of blow you into a kind of a canned portfolio. But that happens a lot. And that's where you get the customization. Any other questions?
Around afterwards if you want to continue the conversation.
Thanks a lot. You guys are way ahead of me.